Good morning, and thank you for dialing into our webinar this morning. This is the third in a monthly series of free interactive webinars where we provide our view on the key tax and VAT updates across the GCC. This webinar supplements our weekly tax flash emails, which are sent out every Thursday afternoon. So if you're not already on the list for tax flash, just flick us an email and we can put you on that list. The aim of the webinar is to give you a snapshot of what we see as the significant issues and announcements in the tax landscape in the GCC, rather than providing any detailed and tedious technical analysis. Before we begin today, I would also like to inform that we're actually holding another free webinar later this month on the latest transfer pricing news and appeal processes for businesses in Saudi Arabia. The webinar will be held on Tuesday, the 24th of November, where we'll be joined by Shiv Mahalingham, one of the most respected TP professionals, for his views on how the tax landscape in Saudi Arabia is evolving as well. So if you'd like to register for that webinar, the invite was in the last week's tax flash. We'll send out another invite as well, but always feel free to get in touch to get that invite. Your presenters today are myself, Mark Gamble. I head the tax practice in Bahrain, Roman Ori, who heads the tax practice in Saudi Arabia, and Tariq Haq, a manager in our VAT team. We'll be assisted by two panelists, Dal Han Hung, a manager in our VAT team, and Dinesh Ravi, a manager in our tax team. We want TaxMatters to be as interactive as possible. So for us, that means having a conversation and not just 45 minutes of lectures. So we really do encourage questions. If you haven't been on a TaxMatters webinar before, the questions app is in the Q&A function on Zoom. So you'll find that on your screen. Please ask questions throughout. We've already got a couple of questions already, so we'll answer either throughout the webinar or there's time at the end to cover it as well. And if we don't get around to your question, don't worry, we will respond in email as well. So let's get started with today. And let's start first with Bahrain. So the MBR has been fairly quiet with announcements in the past month. They have released a new application form to access the profit margin scheme, which can be accessed through the MBR website. The profit margin scheme is a concession available to sellers of second-hand goods that allow them to charge VAT only on the profit margin of the sale rather than the full consideration received. So this means a lower VAT amount. VAT will be payable on the profit margin, which is calculated by deducting the purchase price from the selling price of the good. We mostly see the profit margin scheme used by car dealers who are selling used cars, but it applies more broadly to other businesses that are selling used goods. Tariq, can you talk us through some of the criteria for the profit margin scheme?
Yeah, thanks, Mark. So there's actually a strict criteria in order to apply the profit margin scheme. Firstly, the taxpayer has to obtain approval to use the scheme. Now, that can be done by using a form which is available via the NBR website. The profit margin scheme only applies to qualifying goods. These are basically used movable goods which are suitable for further use in their current state or after repair. Works of art, items of like scientific, historical interest can also be sold under the scheme. Now, please note, if significant repairs are required, the goods might not qualify to be sold under the scheme. So you'd have to think carefully about that. The scheme doesn't apply specifically to supplies of precious metals, precious stones, or pearls. Now, in order to apply the margin scheme, the supplier must have purchased goods in Bahrain from one of three persons. So number one, a non-VATable person, for example, a private individual. So it's like someone like me is coming to sell a car. Number two, someone who sold it under the profit margin scheme previously. Or number three, from a VATable person who can't recover the import VAT. Now, it's important to remember that the supplier must not have claimed import VAT or incidental expenses that relate to the acquisition of those goods. There are several requirements in relation to documentation. We won't go through all of them today, but it is important to ensure a tax invoice or the tax invoice given to the customer clearly states the VAT amount has been imposed using the profit margin scheme. Now, the VAT amount must not be shown on the tax invoice given to the customer. Once the supplier is registered for the scheme, the supplier must apply the scheme to all qualifying goods. So you can't pick and choose which goods to apply them to. As Mark said, the scheme does allow a lower VAT amount to be charged on a sale, which means your customers are paying less. However, there are administrative implications and business implications that should be considered before you opt to apply for the scheme.
For the VAT case study this month, we're going to talk through the different VAT rules that apply to property transactions in the GCC. So as you can see from the matrix on the slide, the VAT rules change across jurisdictions. So if we start first with Bahrain, Bahrain exempts the sale and lease of property. It's true that hotel rooms and service apartments are standard rated, but for the most part, the entire industry is exempt from VAT. And we'll come back as to what that means exactly shortly. Saudi Arabia, before the introduction of the new real estate transfer tax, the sale of real estate in Saudi Arabia was taxable at the standard rate. The only property transaction that was not subject to the standard rate was the leasing of residential real estate. However, from the 4th of October, the sale of real estate is now exempt from VAT and is covered by the RETT. The RETT is 5% and is payable on the sales of land. VAT at 15% still applies to commercial rentals.
Okay, and for UAE, the UAE has slightly different rules to Bahrain and Saudi. They have a concept of new residential property. Now, a new residential property that is newly constructed, is a newly constructed residential building that is either sold or leased within 3 years of the completion of the construction. So if you build a new residential building in UAE, a sale or lease made within 3 years of completion will be subject to VAT at 0%. After that, the sale or lease of the same property will become exempt from VAT. Basically, this allows the developer to recover the input VAT on their construction costs. And commercial property sales and leases are subject to the standard rate of VAT in the UAE. Now for Oman, we only have the VAT law and some limited guidance at the moment, but it looks like residential property sales and leases will be exempt from VAT, and it's looking likely that commercial properties will be standard rated. But I guess we'll need to see what the implementing regulations say. Now, Bahrain exempts everything from VAT. Do you think it's fair to say that Bahrain is the most friendly for property developers, Mark?
So it's a bit of a misconception that if you've got a VAT exemption, you're paying no VAT, so it must be a good thing. But VAT exemption also means that there's no VAT that can be recovered on purchases used to make that supply. So that essentially creates a VAT cost. So in Bahrain, any input VAT incurred by a property developer will become a cost that they will then ultimately pass on to the consumer, which will be embedded in the sale price. So new building construction services are zero rated in Bahrain, but these rules don't necessarily cover all the types of expenses that a property developer would incur to make the building. So there's always going to be some element of that embedded in the sales price. UAE's new residential property rules mean that developers can recover the input VAT on the construction, providing that they sell or lease the property within 3 years of construction. So that allows them to take away that VAT cost because they get the full recovery of the input VAT. We'll have to wait and see what happens in Saudi Arabia with the new real estate transaction tax, but it appears that there will be a benefit for licensed real estate developers who will be able to recover the input VAT on their development costs. But at the moment, it's unlikely that this concession will apply wider in the industry. Moving now to Saudi, the Gazette has released a new publication, which is in Arabic, regarding the VAT treatment of services provided to non-GCC residents. This document supplements the guide covering services made to non-GCC residents. If you provide services to customers based overseas, you shouldn't automatically apply the zero rate just because your customer is based overseas. This is the case even when you're supplying something vague like consultancy services or acting as an agent in a transaction, or even when you're earning a commission from an overseas person. The Gazette at the moment is specifically targeting instances where Saudi businesses are earning commission income from overseas customers. So if this applies to you, you should really look into it, have reference to this new publication as well as the guide.
Yeah, thanks, Mark, for that. So for KSA taxpayers, there are 3 positions when it comes to appealing a VAT assessment. I've been through several over the last few months, and it's an interesting process. So the first position is you accept the appeal, you pay the amount in full, and the case is closed. I think that's quite simple. The second line you can do is reject the appeal in full, but still pay the objected amounts or provide a bank guarantee. So, and then number 3 is you accept part of the appeal and then reject part of the appeal. So when you appeal the VAT assessment in KSA, it's important to remember that the taxpayer is required to provide either a bank guarantee or pay the disputed VAT amount in full before the appeal will be accepted. Now, this is quite problematic where the taxpayer doesn't have sufficient funds to pay the disputed amount and where they are unable to get a bank guarantee from a local Saudi bank. Now, the taxpayer should pay any undisputed amount before submitting an appeal. So we recommend that undisputed amounts are paid well before the appeal is submitted, so the Gazette has enough time to update their systems to reflect any payments made.
Turning now to the real estate transaction tax. So Gazette is yet to release an English translation of the REP guide, but last week outlined a process whereby first home buyers, Saudi first home buyers, can access the 1 million riyals concession. So Gazette and the Ministry of Housing will manage this scheme, and Saudi first-time buyers will need to obtain a certificate from the Ministry of Housing and forward that certificate to the seller. The seller will then upload the certificate to the Gazette portal, where the 5% tax will then be calculated, excluding the concession. Before we jump to the next slide, before we stop talking about the REP, this morning a detailed REP guide was released as well, which is in Arabic. So the English translation will hopefully come out soon. This guide is over 60 pages long, so it seems very detailed. So that should have the answer to a lot of the questions that are remaining outstanding.
Thanks, Mark. Good morning, everyone. Last month was pretty quiet as well from a direct tax perspective in Saudi Arabia. So I thought it would be a good opportunity to go spend a few minutes sharing some of my experiences of the more common areas which are being targeted by the Gazette when issuing assessments to taxpayers. So if we start by talking about transfer pricing, now this has caught a number of people by surprise because, as you would be aware, the regulations only came into effect from 2018. However, over the last few months, and particularly the last 2 or 3 months, we've seen a number of transfer pricing local file audits. So if you're a multinational business in Saudi Arabia and you are related party transactions with sister companies, whether they are inside or outside of Saudi Arabia, of SAR 6 million per annum, you're required to prepare a local file. Typically, what the Gazette is expecting is that in year 1, that is 2018, you would have prepared a local file, and then thereafter in 2019 and 2020, years 2 and 3, you would update them for any changes in the nature of transactions. So what we are seeing is that the Gazette have issued TP audits, and one of the main reasons they are telling us is that they're finding the taxpayers are not carrying out a robust enough economic or feasibility analysis, or they are not using the appropriate comparable business when justifying the arm's length value of these transactions. So I guess the key takeaway here is obviously the taxpayer would need to ensure that the local file is compliant with the TP rules. But more importantly, I think businesses should consider bringing in the head office or their parent company, get them more involved in this so they understand that there are certain requirements that need to be met and that maintaining a local file is no longer just simply a tick box exercise. The next thing was on share reorganizations. Many of you will be aware that the Gazette issued a circular earlier this year saying that they intend to assess capital gains on any intra-group transfer of shares or assets where either the buying or the selling company is not resident in Saudi Arabia. The tax law has stipulated that in order for the gain to be exempt, you're only required for the transfer to happen within the same group, or the asset should not be sold within 2 years from the date of transfer, and doesn't mention anything about the tax residency of either the buying and selling entity. So clearly this is the Gazette's interpretation, and I've seen it being tested because they have assessed transfers going as far back as 2010. So taxpayers should be mindful of this, and probably a good time, considering that the amnesty provisions are still in place, to voluntarily come forward and disclose these transfers. Of course, they do have the option of filing appeals should an assessment be raised in the future. And then the next one is on non-resident tax, more commonly known as withholding tax. This is a favorite of many a Gazette officer and is tested time and time again by them. So as I'm sure everyone's aware, withholding tax is borne by the non-resident who derives income from a source inside Saudi Arabia, but is actually paid by the local entity on their behalf. Companies particularly at risk of not settling withholding tax are those that have a large number of transactions. So if they are receiving services from or loans from non-resident related parties, or if there are any set-offs between the payable and receivable with the same connected party, then these are the kind of instances where sometimes the withholding tax has not been settled. So again, it's a good opportunity. As many of you would be aware, the rates are higher on related party transactions. 15% is the minimum. Therefore, taxpayers should consider voluntary disclosing if withholding tax has not been settled on such payments or set-offs. And finally, on revenue reconciliation, this is with the advent of VAT, the Gazette now has the visibility of the revenue that is being disclosed by the taxpayers through the VAT filings. So what we've seen is in the assessments, the Gazette is comparing the revenue disclosed in the returns to the revenue that's been reported in the financial statements. And as with foreign purchase reconciliation, with the custom bayan, there will always be a gap or a difference between the amounts reported between the returns and the financials, for the simple reason that the revenue recognition policy is different under accounting principles as opposed to the VAT rules. And therefore, the suggestion or the advice to taxpayers is to ensure that they have a reconciliation to hand so that they can justify these differences.
Turning now to the UAE. So the UAE's Federal Supreme Court has recently released a decision regarding when late payment penalties for outstanding VAT liabilities start to accrue. When a taxpayer identifies an error or mistake, they have 20 days to submit a voluntary disclosure and notify the FTA of the mistake. The court has said that a late payment penalty, which is due in addition to the fixed penalty of $3,000 and a percentage-based tax benefit penalty, becomes payable from the date of the original VAT return in which the error was made. The penalty will accrue from this date until the payment of the VAT liability is received by the FTA. Late payment penalties are calculated on the number of days for which the payment remains outstanding at rates of 2%, 4%, and 1%. These rates progressively change as the time increases, and there's an upper cap. So if a mistake occurs in January, but it's only identified in June, there's at least 4 months of late payment penalties, which would have accrued since the due date of the January return, which is the 28th of February. So what we can take away from this decision is that the FTA is taking VAT compliance very seriously and is not afraid to impose harsh penalties, even when you voluntarily disclose the error that you've made to the tax authority. So it's more important than ever to take your VAT seriously and make sure you get it right from the start.
Okay, moving on to the economic substance regulations in the UAE. I mean, we've covered this briefly in our previous webinars, but with just under 2 months to go now for the filing of the first economic substance return, I guess now is the best time to maybe go through this in a bit more detail so that eligible licensees can understand what they need to do between now and the 31st of December to comply with the rules. So you've got the flow chart in front of you. This has been, this is the guidance that has been issued by the Ministry of Finance on their website. So if you look at it, what we're seeing here is that if you're an eligible licensee that undertakes a relevant activity, so undertakes a particular type of business, and you generate income from that business, then you are required to comply with the economic substance rules. Now, how you do that is that you need to broadly meet 2 tests. Number 1, the licensee should be managed and directed from the UAE. So what we mean by that is that the board of directors meetings, the minutes of those meetings should be held in the UAE, and there should be at least a quorum or a majority of directors present at those meetings. And the second one is the licensee should have adequate business premises, employees, and incurs sufficient economic expenditure. Basically, they should have enough commercial substance to prove that there's a rationale behind doing business in the UAE. As always, there will always be some exemptions. So natural persons or taxpayers who are tax resident outside the UAE are exempt from these rules. But by and large, there is, and you will see them on the next slide, there is a list of relevant activities that fall under the rules. One point I wanted to mention, particularly with regards to intellectual property businesses, they are considered high risk, and the default position from the Ministry of Finance is going to be that they do not comply with the economic substance rules. So in addition to the 2 substance tests, they are also required to meet 2 additional conditions. 1, the intellectual property assets should not be licensed from or funded by a foreign connected party. And 2, the local business in the UAE should have adequate financial resources and people expertise to be able to internally generate, exploit, or license that IP for income. Moving on to the, so I mentioned to you this, the next couple of slides, this one and the next one gives us the list of the relevant activities. I'm not intending to go through this in any great detail because this are all on the Ministry of Finance website. But I would like to highlight a few important points. You can see over there that for each relevant activity, there's a list of core income generating activities. So these are the activities that actually generate revenue for the business. So these activities must be undertaken in the UAE. All of these businesses, with the exception of the holding company, are required to meet both the substance tests I referred to earlier. The only one that doesn't have to apply with, comply with the with the managed and directed test is passive holding companies, because these are considered to be investment companies simply for the purposes of holding shares and receiving dividend income. The UAE Federal Tax Authority has been appointed as the national assessing authority that will be responsible and to ensure that businesses in the UAE comply with the rules. And they have the responsibilities to determine if a licensee is compliant, application of penalties for non-compliance, and issue any decisions under appeal. The Ministry of Finance itself will also have the overall overarching responsibility of exchanging information with a foreign government or tax authority providing details of non-compliance by the non-resident. And this in turn would increase the tax risk, obviously, for the multinational enterprise, in the sense that profits that were previously generated in the UAE could now be taxed in the home jurisdiction if there is no commercial reason why those profits are being credited in the UAE. And finally, just on the next slide, please. And finally, just on the filing requirements. So these are the steps that licensees need to take between now and 31st of December 2020. So businesses which have a financial year ended any time between 31st December 19 and 30th of June 2020 are required to file a notification of compliance. Previously, the deadline was the 30th of June, so if you've already done so, you're required to refile it. Additionally, for 31st December 19 year-end businesses, you are required to file an economic substance report. This is now going to be an annual obligation, so a report will have to be filed every year. The filing itself will be done electronically through the Ministry of Finance portal, which is expected to go live for submissions by any time in the first week of December. The notification and reporting templates were released by the Ministry of Finance just last week on their website. The penalties for failure are substantial. So for failure to file the notification, it's 20,000 dirhams. And for failure to file a report, it's 50,000 dirhams. And one final point is we've assisted a number of businesses in Bahrain who went through this economic substance compliance regulations last year, and we found that the authorities out there adopted a more lenient approach by issuing warning notices or violations rather than imposing penalties. So what the UAE will do with regards to the penalties, we're not quite sure, I guess anyone's guess, but they have announced, again that was done last week, that they will give consideration of the challenges that are currently faced by businesses on account of COVID-19. So the hope is, just like in Bahrain, the UAE will adopt a softer approach because of the prevailing situation.
Okay, turning now to Oman. So actually on the last webinar that we held, that was when the Oman VAT law was released. So our last webinar didn't cover it. But it was released, and now Oman will implement within 6 months. So the expectation is April 2021, but the actual date is yet to be confirmed. The VAT rate will be 5%, with specific suppliers qualifying for 0% and an exemption from VAT.
Yeah, and the zero rate of VAT will apply to exports, some food items, medical goods, international transportation, crude oil, etc. And on the other hand, supplies of financial services, healthcare, education, undeveloped land, sales and rental of residential land, and local passenger transportation is going to be exempt from VAT. Now, the place of supply rules for goods and services seem to mirror the rules applied in Bahrain. The place of supply of goods obviously depends on whether the goods are supplied with transportation, and if they are, the place of supply is where the transportation starts. Now, the place of supply of services depends on whether the customer is taxable or non-taxable. It's important to remember across all jurisdictions that once the GCC member states implement an electronic services system, the rules will change for all intra-GCC transactions. So it's something to be aware of when you're setting up your systems. There's also the usual special place of supply rules for real estate transactions, transportation, sporting events, and that type of supply.
One of the interesting parts of the Oman VAT law was this concept of a responsible person. So unlike other GCC VAT systems, it seems that there will be a strict requirement for businesses to appoint a natural person to be their responsible person. So this person will not be able to stay outside of Oman for more than 90 days in a calendar year unless the tax authority is first notified and another responsible person is appointed. And strict penalties will apply if these requirements are not met. So we haven't seen this requirement for other jurisdictions. So that's an interesting one, and businesses operating in Oman should be conscious of that. There's still a number of points that will need to be confirmed. At the moment, we only have the VAT law as well as 2 or 3 guides, but they're quite high-level guides. So we'll need to wait for the implementing regulations and further guidance. So some questions: will the implementation process be staggered based on, say, a revenue turnover? Are non-residents required to appoint a responsible person? Because there might be some difficulties with finding someone local who wants to take on that responsibility. And the exact scope of zero rating and the exemption rules. But if you have a business in Oman, you can start thinking now about how that will impact your business. So similar to how you would have done the implementation processes for Bahrain, Saudi or UAE, you should start looking at the types of suppliers you're making, whether you're acquiring things from overseas that might be subject to the reverse charge, just to determine whether you have an immediate requirement to register for that. You should start to prepare for that registration by conducting an impact assessment. So you look through your organizations, your IT system to make sure that you are ready to make the required updates. Whether you do this in-house or engage an advisor is up to you, obviously. As and when more information is released, there'll be more publications from advisors. Looking just finally now to Kuwait and Qatar, there's nothing new in Kuwait on tax or VAT. In Qatar, the Dariba portal, the registration process has now been extended to the 31st of December of this year. So if you are required to register online for tax in Qatar, you can do so. Otherwise, there's nothing new to share on tax or VAT. Now that concludes the content section of the webinar. We have received a few questions, so we'll spend some time working through that. There was a couple through the chat, so I'll just cover that. So a question about GCC countries are still considered as non-implementing states. So when we read the articles for zero-rated exported services, we should read it in that way. So that's correct. So there's no special rules for GCC countries yet. If you're in Bahrain, treat your supplies made to Saudi as supplies made to any country, really. All right, let's get some questions. So, a KSA company provides IT-related services to foreign customers, but server and other infrastructure is located in Saudi. Is it export transaction? So what this question is getting at is the export of service rules. So in Saudi Arabia, if you're a supplier supplying services to a customer located out of Saudi, then the starting point is that it's zero rated, but then you have a number of criteria that, if applied, will make the supply subject to that of the standard rate. One of the criteria is when the services relate to tangible goods or real estate located in Saudi Arabia. So if you're providing IT-related services, you need to consider whether your services are in relation to tangible goods or real estate in Saudi Arabia. Just because you have a server or other infrastructure in Saudi may not impact this, because I guess if you draw an analogy, if I'm a consulting company providing advisory services, I'm based in Saudi, but my customer is outside. I've got a building, I'm leasing premises, so I'm working from real estate, but that's not necessarily in relation to my supply. So short answer, you can probably zero rate, but have a look at the rules. Can we claim that on pantry expenses?
Yeah, so I mean, your normal tea, coffee, biscuits and that sort of thing is normally fine. I mean, if you're able to recover VAT anyway, then you can, but if obviously you're a VAT exempt business, then obviously you won't be able to claim that either.
Thank you. I lease out commercial property in Saudi Arabia. Do I have to charge VAT?
Yeah, if you lease out commercial property in Saudi, you will have to charge VAT.
And what's the rate?
The rate is now 15%. Now, you'd obviously have to look at your contract as well, because if you don't have a VAT inclusive or exclusive clause, it may make an impact. So you would have to have a think about that.
Cool. Is withholding tax applicable on payment to non-residents, related parties, or on booking of expenses?
Okay, good question. Well, basically there's two conditions. One is that the expenses should be booked in Saudi entities' books. The withholding tax itself is payable upon payment, so it's not upon the booking or upon the issue of the invoice. It's payable on once the expense has been once the payment has been made to the non-resident party.
Are all companies in Saudi required to maintain a TP local file?
Short answer is no. First and foremost, you need to meet the conditions of a multinational enterprise. So you need to be operating in two different jurisdictions. And secondly, it also depends upon the amount of, the value of the related party transaction that you have. So if you are over 6 million Saudi Riyal per annum, then you're required to maintain a local file and a master file.
Any insights on income tax implementation in the GCC countries?
Who knows? Things are changing rapidly. I mean, there's been announcements galore everywhere. I mean, Oman is talking about introducing income tax, although that's only been reported in the local media. So it's anyone's guess. I mean, we've got corporate tax in Saudi, we've got corporate tax in Oman. Kuwait has got tax on foreign shareholders' shares. So there is corporate tax in the region. I mean, the question is whether Bahrain and UAE will do it. Short answer, I don't really know, but I wouldn't be surprised if that happens over the next 3 to 5 years.
And sticking with this kind of theme, potential for VAT rate increases in UAE, Bahrain, similar to what Saudi did. Tarek, what do you reckon?
It's a difficult one. I mean, Saudi applying 15% and then Bahrain applying 5% and then UAE 5%. There's obviously a mismatch, so it may lead to consumer behavior, where you go to a different country because you get a cheaper VAT rate. I don't know, it's difficult to say, but I wouldn't be surprised if they amalgamated the rate at some point in the near future.
VAT implementation dates for Kuwait and Qatar, there's nothing really to go on at the moment. So yeah, not sure. What is VAT grouping and what's the benefit of VAT grouping? So VAT grouping is where you have multiple taxpayers, multiple entities that are commonly owned, and you want to put them into one group so they're treated as a single taxpayer for VAT purposes. The benefit of doing this is if you have transactions that are between these group members, you can ignore them for VAT purposes. So if you've got subsidiaries of a holding company and they're making supplies to each other, without VAT grouping, they need to charge VAT. With VAT grouping, they won't need to charge VAT. And you submit one VAT return. So that's really the main advantages. The disadvantage of grouping is all the group members are jointly and severally liable for the VAT liabilities of the other group members.
Just a quick point about the VAT grouping, Mark. So you could have, say, 5 entities in a VAT group. 4 entities are ready to submit that VAT return, but they've got to wait for the 5th person to get ready as well. Otherwise, they wouldn't be able to go ahead and submit. So that's something to think about as well.
Yeah. What's another question? What is the threshold value to maintain a TP local file?
Yeah, I think I answered this question previously, but yeah, just to repeat myself, it's if you're a multinational business that has related party transactions of more than 6 million per annum, you're required to maintain a TP local file.
So a retail store giving away free items like flowers, snacks, coffee to customers. Are these deemed supplies? Do we need to account for output tax?
Depends. Depends on the values that you give. So there's a threshold per person, and then the threshold which is annual. The thresholds are different for different countries. So if you don't recover any input tax, then there's no issue. But if you have recovered input tax, then you will have to account for output tax if the value of your supplies go over the thresholds.
Is it okay to use the adjustment column of the VAT return to report errors? We don't want to use the correction box or amend previous VAT returns. What are your thoughts, Tarek?
Well, I know of taxpayers that have, used the adjustment box because they've been worried about using a correction box and the potential impacts for penalty purposes. Obviously, that is not correct. We would never tell anyone to use the adjustment box where an error has clearly been made. And I would recommend people reassess, their situation in detail, especially because the Gazette could come back and say, well, you should have reported it as an error. Why have you reported it as an adjustment? Or NBR could do that. So
yeah.
that's something to think about.
The adjustment column is really only for where you issue a credit note or there's a change in value to your supply.
Yeah.
Can we claim that on a bank vehicle insurance expense, which is in the custody of the manager? So I'm assuming you're referring to vehicles used by one of the employees of the company. You're incurring insurance on the vehicle. Can you recover the VAT?
Well, there's two things to consider. The first thing to consider is, are you keeping any records? If you're not keeping records, then you probably have to consider using a simplified method.
Records of what?
Records of the vehicle use of the vehicle. So it's unlikely. A lot of people in GCC don't keep such records, and it's quite administratively burdensome. In that case, what we recommend is consider using a simplified method. So, for example, in Saudi, there is actually no recovery at all, but in Bahrain, you can recover 40% of the import tax. So it actually depends on what country you're from or country you're operating in as well.
Great. Can you explain the difference between the real estate transfer tax and VAT? So just briefly, the real estate transaction tax, so that's the new 5% tax payable on property sales in Saudi Arabia. So it's different from a VAT in the sense that it's not really, you can't recover rent. Once it's paid, it's payable. The recipient, when they purchase the property, it was going to incur that cost. So that's the main difference from a VAT. A VAT, you can, if you're taxable businesses, you can recover that cost. So before, if you were buying property in Saudi that was subject to the VAT at a standard rate, but you were a taxable purchaser, then you could recover that VAT. The RET is not the same, unfortunately. So in that sense, it's more akin to a stamp duty than it is to, I guess, a tax on consumption like a VAT. Question around purchasing of airline tickets. So purchase of tickets from Bahrain, where the agency is based in Saudi, are these suppliers subject to withholding tax?
Yeah, good question. I guess what you need to, the key question here is where are the expenses being booked? So if the expenses are being booked in Bahrain, and obviously when the payment is made from Bahrain, then there is no withholding tax. However, if the expenses are booked in the agency's books in Saudi, then there will be withholding tax on any payments made in connection with the airline tickets.
Great, thanks, Raman. There's maybe time for one or two more questions. Feel free to ask them through the Q&A box. If I have, so has Oman said the VAT rate will be 5%, and when will we know what the standard rate is? So the standard rate will be 5% in Oman. What we don't know is the full extent of the zero rating rules and the exempt supplier rules. So we need to wait until the executive regulations are released, which we're expecting them to be released in December, but ultimately it could be as late as April. One last question, marketing and support services from a KSA group, a KSA company to group entities in GCC, would it be a zero rated export of service? So again, this is going back to we're getting a lot of these questions lately because the Gazette has released a guide on this. So you need to look at whether your services can be zero rated as an export of services. So marketing and support services usually come into issues when they relate directly to real estate or tangible goods located in Saudi. So you need to analyze your transaction to see if there's a nexus to those tangible goods. Okay, that brings us to the end of our webinar. We don't like to go longer than 45 minutes, so we keep it brief and to the point. We will send around a copy of the slide deck and the questions and answers that we covered. If you do have any questions or we didn't get to your one, please send us an email. We're happy to answer any questions you have through email as well. But thank you very much for dialing in. Our next webinar will be next month. We hold them monthly. We also have our transfer pricing webinar at the end of this month. So please get in contact with us if you haven't already received an invite. But thank you and have a great day.
Thank you.